Hi, welcome back to this reading on fixed income, fundamentals of credit analysis for student candidates for CFA Level 1 program 2021-2022. Student candidates are advised to pause the video and go through the disclaimer page. After having completed this reading, it is expected that you will have a good grasp on the following learning outcome statements as has been defined by the SAFE Institute. So, namely, we will start with credit risk and sources of credit risk, which is other than the market interest rate, of course. We're going to introduce a concept called expected loss and the two subcomponents of expected loss known as the probability of default and loss given default. And we will see that how they actually impact the valuation of bonds between the investment grade as well as the non-investment grade. We're going to talk about the debt structure at large and how the senior creditors' claims are being protected against that of a possible default, and who stakes what claims on the company's asset should there be a run on the company in the event of default. We are also going to discuss the bankruptcy proceedings, and we will see inherently why it is so complex to liquidate a company uh, and protect the interest of the junior bondholders. We're going to distinguish between the corporate issue rating and that of the corporate family rating as and that of the corporate issue rating, and we will see that why the corporate issue rating itself is more pivoted towards the corporate family rating. We're going to learn something about the rating agencies, the need for rating agencies, the reliance on rating agencies, and we're going to discuss their opinions, what is meant by the considered opinion of rating agencies, basically how they perform, and what are the pitfalls of rating agencies as well. The holy grail for credit analysis around the four uh, pillar, that is character, covenant, collateral, and capacity. And we're going to deploy some financial ratios in evaluating a credit matrix of a company. Basically, this is going to be more to do with the diagnostic tools that you're going to learn in your FRS section, and really got nothing much to do with the fixed income. Apart from that, there is not much of a mathematics involved in this chapter. We're going to talk about the yield rate and the volatility around the yield rate, and distinguish between the high yield corporate bonds, sovereign bonds, emerging market bonds within sovereign itself, and the non-sovereign government bonds as well. What are the points to keep in mind while investing in emerging economies or the high yield corporates? So let's first start. So as far as credit risk is concerned, so you already know that the biggest credit risk that actually can happen to your investment in portfolio is that of a default, wherein the issuer actually fails to meet its responsibilities and obligation towards the coupon payment or that of the principal. The second aspect, in fact, which is also very closely related to default, is that of delinquency. We have discussed at length the difference between default and delinquency and how the delinquency, being a persistent delinquency, may eventually lead to a default. And here we're going to make a distinction between the loss matrix, which is on the right side of this particular divider, and the other aspects of delinquency and default. So first, let's start with the downgrading of the technical default, that is, as it is called. Now, you need to understand that default is, one is that the defaulted bond will obviously fail to generate the cash flow and distribute it to the bondholders. But before that can actually happen, which is the ultimate catastrophe, the bond prospectus also incorporates certain technical default. The technical defaults actually warns us beforehand that if not taken due corrective measures, then the actual default may take place. So a technical default could be that of something called as simple as that of maintenance covenants, which is to say that in the bond prospectus, a minimum maintenance of the debt service coverage ratio, or the utilization of funds, there will be certain cap of it, or running of risky projects, there will be certain cap of it, or what be the cash proceeds. What is the maximum cash proceeds that can be actually distributed to the equity holders? So all of this may be actually incorporated in plain, or let's say legalese language, in the bond prospectus. Any or more than one violation or breach of such covenants will lead to something called as a technical default. A technical default may also arise if one of the cross default provisioning actually triggers. So that would mean that, for instance, an issuer already, let's say an issuer has already five issues in the market and it has come up with the sixth issue. Now, regardless of how this sixth issue is being rated in the market, from the old outstanding of the bondholders, so let's say the issuer actually defaults in a couple of them. So when such a thing happens, the latest bondholder should take due cognizance of the situation, because it won't be long before this actually catches up with the latest security being issued as well. So these are parts and parcels of something called as the technical default. Now here also we're going to introduce one more concept called the market liquidity risk. So the market liquidity risk is basically the inability to trade the bond in the given market price. Now, typically, a fixed income security is not as liquid as that of an equity security, which means that there are going to be sometimes, at times, considerable spread difference between the bid-ask rates. And secondly, even with the spreads given, there may not be guarantee that the market of surprise on which you would like to place your trade order will be executed. So that's called as the market liquidity risk. So the market liquidity risk, now this is a little bit of counterproductive in nature, or should I say it's a cause and result effect, uh, cause and effect kind of a thing, which goes back and forth. The more the market liquidity risk, the greater the bid-ask spread. The greater the bid-ask spread, greater is the spread risk. The greater the spread risk, because of the prevailing market circumstances, which could be other than the company's own merits as well. There could be general economic depression. There could be government policies which could be adversarial to the fixed income market as a whole. So those may easily translate into a greater spread risk across the fraternity of the fixed income population, which will trigger a greater bid ask rate as well. And then it will come back to, it will impact the market liquidity risk as well. So we need to understand that, this is a little bit of a chicken and egg story kind of a thing, but nonetheless is very much a reality. Delinquency, as I said before, is the inability to make the payment on time. So if the coupon due is on June 30, the organization or the issuer persistently makes payment on, let's say, July 31. So there is an opportunity loss of almost 31 days. So that's delinquency. As I said before, that delinquency per se in itself is not much of a worry if it happens, infrequently. But persistent delinquency obviously does raise the concern of a possible default in the future. So these are the primary risks that one needs to be aware of, and we're going to boil down them threadbare, depicting each and every subtopic and how they actually impacted the issuer as well as the bondholder. Now, the market liquidity risk is also inherently being found to be impacted by the size of the issuer, the credit quality of the issuer, and the outstanding debt of the issuer in the market. So typically, if the issuer itself is not that big, or its debt are infrequently traded in the market, but naturally the bid ask spread will be much more. Similarly, if the issuer does not have much of a tradable debt in the market, so if it is, for instance, if the issuer, it may be a great company to begin with, but it has only a very limited history of floating debt in the market. So obviously there will be a little bit of skepticism surrounding the issuer. So such kind of issuer will definitely not going to enjoy a thin bid-ask spread. But obvious, if the credit quality of the issuer is a suspect, that will also impact the market liquidity risk. And with regards to the outstanding market debt, now here the outstanding market debt should be taken as a tonic itself. What do we mean by that? It's like if you have a healthy dose of outstanding issue in the market, then to that extent, that actually indicates the issuer's propensity to manage its debt capital effectively and efficiently. But, however, if the issuer is heavily lopsided towards a debt issuance, that is to say that the issuer has too much of a debt in outstanding in the market, so issuing one more debt in the market may be counterproductive, or it might actually warrant higher yield to begin with. So these are some of the things that would also constitute part of the market liquidity risk. Now, as far as the loss is concerned, or the expected loss is concerned, know this, that expected loss can only manifest when there is a default which has come into the picture. So if there be a default, then the expected loss comes into the picture. So you would want to know that if in the event the issuer defaults, what is it that you can recover from the market as part of your principal that you have invested. So there is a straighter formula. So that is your invested principal. So your invested principal and the probability of default. So this is the amount of default this is the amount of loss. This is the amount of loss total that you can expect. So this translates to the loss given default multiplied by the probability of default. Okay. So that is the one line formula for coming out with the expected loss, enumerating the expected loss. Your CFA text does not go much deeper than that. But natural, the loss given default is nothing but 1 minus the recovery rate into the probability of default. Now, the Bureau of Statistics, they periodically release and publish the data regarding the fixed income market as regards in any particular any developed market. They would do this, and they would come out with the past records of the expected loss across the rating spectrum of, let's say, AA security. But of course, AAA securities cannot default, so there is no question of loss given default or expected loss thereof. But AA onwards, up until the default category or the C category bonds, which are also called as the junk or the super speculative bond, non-investment grade. So they do publish the historical anecdotal data as well, and the Bureau of Statistics also come out from time to time regarding the possibility of default in the coming quarter or the coming half yearly or the coming 6 months time. So the takeaway from this particular slide is that you need to understand that apart from the market interest rate, which directly impacts the value of the bond, which you can live with if you are a long-term investor, because at the end of the tenor, market interest rate really doesn't matter if you're holding it till maturity, because until and unless the issuer defaults, you're bound to receive and get back your principal. But other than that, any time interim, there is a possible and a very realistic threat of default, which translated to something called as the credit risk. Credit risk in terms have got two components. One is the direct default, another is the delinquency. Direct default also has two more components, which is the direct default itself, which means that there is a catastrophe which has had already taken place, and on this other part is that preceding that catastrophe there be a technical default. We also discussed about the market liquidity risk and how the market liquidity risk can easily spiral into escalating spread risk, which in other terms will again be one of the main causes of default itself. We discussed about the expected loss as well and have given you the formula for expected loss. And yeah, that's about it. So let's now take a closer look at the columnar structure of the debt itself. So in any organization, regardless of the balance sheet, this is the, by and large, this is how the debt structure or the capital structure itself will look like. So you have the first mortgage. First mortgage would mean that the property or the very hard assets of the company itself, on which the senior most creditor will have the claim. And then hierarchically, in a waterfall structure, this is how the priority rule dictates as far as the claimants are concerned. So you have a first lien senior secured, second lien senior secured, followed by the senior unsecured, senior subordinated, and then the junior tranches, which are more akin to the equity tranche. Some of them do actually, in fact, this particular portion share majority of their characteristics with the equity tranche, rather than that of the fixed income itself. So the first lien is called the first mortgage, and then thereafter the first first lien. Sorry, before first lien, the senior secured is called the first mortgage, wherein it is secured by the basic property of the issuer itself. In this first lien, the collateral or the assets backing that particular debt that are being issued in the market would be other than the first mortgage. In fact, it could actually engulf the first mortgage plus, there could be other assets in the terms of hard assets, in the term of equipment, um, or in the terms of account receivables. Those are obviously part of your current assets. Or it could be patents or copyrights. These are the things which do form part of the first lien. Second lien is, of course, something more than this. So as it goes on, and that's how it happens. But the most important thing is that we need to understand that in a typical waterfall structure, this particular issuer who sits at the top, that creditor's interest will have to be met first before anything else could be met. Anybody else's interest could be met. So even to the extent that the first mortgage is secured against the debt issue, or the senior lien holders are secured against the first mortgage, as far as the debt is concerned. But should there be a default, then and if the first mortgage is insufficient to meet the first mortgage, the collateral in this case is insufficient to meet the debt obligation of the senior notes holder, so to that extent, then the first lien becomes unsecured. So in what would happen, let me just exemplify. For example, let's say the first lien, when it was issued in the market, amounted to $100 million, and it was secured against a property, which is basically the plant or building of the issuer itself, which was, let's say, $102 million. So this, to begin with, is fully 100% secured because it is completely collateralized. But over a period of time, the building may have suffered some kind of depreciation, or there could have been some sort of events in the building, for example, fire or a major breakout or a repair or maintenance schedule, which renders the value of the building depreciated. And in such case, let's say 3 years down the line, the carrying value of the mortgage against which the first lien's debt was issued, the carried value of this mortgage, let's say, becomes $85 million only. So now, to the extent of $15 million, this particular senior notes holders are unsecured. But having said that, they would nonetheless would have again senior priority over and above the first mortgage itself. So that would mean that they, in this case, would stand to recover their leftover balance 15 million from equipment. And even if it is not sufficient to meet the proceeds of equipment, they might actually encroach upon the patents, copyrights, so on and so forth. Now, all of these things are not that easy as they sound. That, of course, depends upon how it is depicted in the bond prospectus itself. Nonetheless, as a rule of thumb, you must remember that the first lien or the senior most lien enjoys the maximum protection against default, and their debt component is supposed to be fully secured against the assets collateralized. All right. Now, bonds with similar hierarchy in the columnar structure of the debt itself sit pari passu, regardless of their amount and maturity. What it means? So, for example, let's say we have a junior note holder. So junior notes are issued. There are a couple of them. One is issued for $80 million principal or face value for a period of, let's say, 7 years, and they have been rated, let's say, triple B plus. Another is 20 million, and let's say they have been issued only for 5 years, yet they are also rated as triple B plus. Now these two bonds, even though the principal amount may differ, the tenor may differ, but they sit pari passu. All that it means is that their claims to the effect of liquidation, or their claims to the effect should there be a default, will be treated in a similar manner or in the same manner. In fact, to the extent that their cash flows are meted out to the bondholders, also take similar priority. So this is the meaning of pari passu. As far as the junior tranches are concerned, the junior tranches are, of course, very much akin to the equity tranche, or because this is the riskiest piece as far as the debt components is concerned, because after all the seniors have had their share of cash flows, the junior subordinates will receive their. So we have discussed this time and again in our preceding so many videos that so long as the seniors' interests are not met, it is very much unlikely that the junior subordinate holders will receive their share of the pie. Now, the compensation towards that is that they enjoy a very high yield. Since they enjoy a very high yield with respect to the seniors above them, the analysis warrants that these kind of notes be analyzed in at least a hybrid manner, if not fully like that of an analysis of an equity stock of the company, rather than they've been treated purely as a debt instrument. So, having understood all of that, let us understand that what is the motivation behind making the debt columnar structure so complex, and what is the need, what is the rationale behind issuing so many debt with so many different priorities. So the first and foremost thing that comes to my mind is optimization of the capital structure itself. So the issuer may have a target weighted average cost of capital, which will have, let's say, on a broader basis, 70% debt and 30% equity. And the target WACC could be, anything. Let's assume that this is 12%. So out of this 12%, let's say the equity portion may contribute something close to, on a weighted basis, they might contribute something close to, let's say, 5%. This would mean that the debt component will have to contribute for the rest of the 7%. So in order to achieve that, the issuer may do the permutation combination or do a mix and match in such a way in terms of the amount of principals being issued as part of the debt, the tenor, the coupon interest that is being paid, that all of them put together, this basket of first lien debt, the second senior notes holder, senior unsecured, senior subordinate or subordinate, the junior tranche, all of their weighted cost of capital put together equates this 7%. So this is called the optimization of capital structure because the issuer has a certain target to meet. On the other hand, there could be certain restrictive covenants as well, which would necessitate that the issuer may not actually issue any particular class of debt beyond a certain threshold limit. So the issuer, in order to meet those obligations, may actually want to issue debt in different priority and different hierarchy. At the same time, the issuer also understands that as far as the senior notes are concerned, though the yield is less, but the covenants might be way too restrictive for retaining flexibility for the issuer in order to execute the projects for which the debt was raised. So in order to earn the flexibility, the issuer may sacrifice some yield and will be ready to pay more yield, but buy in that necessary flexibility. The very reason why a junior unsecured notes are actually issued in the market. On the other hand, as far as the investors are concerned, the investors are more concerned, they like this extra yield that they get, and more so if it is coming out from an issuer which enjoys a good market standing, which enjoys a good rating with the rating agencies. So typically, if I'm an investor, any day, if given a choice between two bonds of AA, one yielding 6%, 5%, and another AA, or let's say A plus, they yield 8%. I would any day prefer this because I like this extra 300 basis point more yield. This 300 basis point yield comes because of this mix and match of the different hierarchy structured debt components. So these are the two counterproductive factors. These are two balancing factors why such a complex debt structure may exist in the very first place. Okay. Now, having had a good amount of understanding about the debt issues, let's also talk about what happens if there is a default. If there is a default, typically the immediate concern that actually becomes of paramount importance is that what is it that the debt holders can expect to recover out of it? As if you would know, and it should sound intuitive enough that senior the note holder notes senior notes and the senior notes holder can expect very high recovery rate, as opposed to that the junior notes holder may not expect that recovery rate at all. The very reason that they're ready to absorb this higher amount of loss, in compensation of which they receive the higher yield. But of course, the recovery rates, or the antithesis of recovery rates, that's basically the loss given default, are also impacted, are also influenced by when are they occurring in the credit cycle. So typically, if the going is good, so let's say we are at the upper hand of the market. If there is a default in the economy, when there is a default where when the economy is in good state, is in the upswing, the recovery not only could be faster, but the recovery rate could be very high, even for a low graded security. On the other hand, if it is the, if the default happens, so the economy is really depressed, at that particular point in time, even the higher grade securities may suffer substantial loss. So at one point in time, the credit cycle, the default happens is of course also of paramount importance. Of course, this beggars one more important aspect, that which industry we are talking about. There are industry in nature itself. We are going to study them a little bit more when we study the Michael Porter's five force model. But there are industries, the very nature of them itself is a declining in nature. Very nature of this itself is a declining. For example, the print and media industry. So because of the digital boom, the print and media industry are no longer, or at least they should not target a very high growth rate, because that's just not possible. So any issuer pertaining to those industry may actually face a considerable default risk, and in those kind of default risk, the bondholder may not expect a full 100% recovery. Also, it is pertinent to mention that some companies or some industry may be cyclical in nature. What do we mean by cyclical in nature? Let's say, for example, the steel industry. The steel industry has been seen historically having periods of upsurge and down moves. So there will be an elongated period wherein the steel industry would be seen to be performing very well. In fact, what we are witnessing these days now, especially in countries like India, and then followed by a elongated period of slump. So as before, even though the general economy may be in a good or a bad condition, the sub industries like that of the steel industries, which are cyclic in nature, if it is in a good state, the recovery rate could be high. But if the opposite happens, the recovery rate may really take a huge amount of beating. So not only the credit cycle, but the cyclical nature of the industry itself also will need to be taken into consideration before we actually boil down to the recovery rate. The recovery rate is also impacted by something called as the absolute priority rule. Now, the absolute priority rule in a nutshell is nothing but actually defending the rights and privileges in this waterfall structure of the first lien securities followed by the second lien, so on and so forth. But in an absolute priority rule, that's how the dictum is. But more often than not, these kind of catastrophes, these kind of defaults, if there is a claim on the company's assets, it is not without legal hurdles or legal battles. Typically, the ones whose interests are impaired, for example, the equity tranche or the junior notes holder, they may actually impede the absolute priority rule process. They may put in they may put in legal hurdles in front of the claimant, and the drawback of that is that since their interest is impaired and the legal battle ensues, the company's prospects and legal battles are time drawn effect. They may take years together, if not decades. And in such a case, the company's prospect may worsen further, thereby depressing the present value of the assets, and thereby, even though in a letter of spirit, the absolute priority rule may dictate that the senior notes holder may stake their claim first. By the time they could actually receive their claim, it might be too late or the value might be too less. So too late, too little is what is the fear that might actually engulf the senior notes holder. So in situation like this, the J factor or the judge factor may also play a pivotal role. We also need to understand a few more things, that not always all unsecured loans are risky in nature. As with any balance sheet, we have the debt component beneath which sits the equity component. Now, here we need to understand a few important aspects. If the equity component is wafer thin, the thinner the equity component, which means that the leverage structure is high, then in such a case, the whole structure may crumble like a house of cards in no time, even at the slightest provocation, economic shocks. But if the equity itself is sizable in nature, that is to say, the leverage itself is low, so in such a case, the debt holders have an additional coupon. But obvious that the debt holders will have the first stake and the first claim, regardless of their hierarchy in the structure of the regardless of the hierarchical structure of debt, over and above the equity holders. So in a capital structure, the thicker the equity bucket, more protected the debt bucket is. So this also lends itself to the whole recovery rate as well. So just because the issue is unsecured, it does not necessarily mean that it is actually very risky by its nature itself. It is to be seen in the holistic perspective of what the total capital structure is and how much of a cushion the equity portion is ready or is able to provide. So I'll just read out, the same thing that we have discussed here, that matter of legal proceedings can go on forever, and thus negating the prospects of recovery, if any. Now, a couple of things that we need to understand is that uh, since any claim stake may result in a dispute, and the dispute being eventually leading up to the court of law, which may take years to settle. So the reorganization route is a preferred route wherein the impaired credit class notes holder, along with the equity shareholders, may chart a middle path along with the senior notes holder to find out ways by which the present condition may be improved. It's a win-win situation. Of course, we also need to understand that even though a liquidation may be the last route to take, not always the liquidation route will result in great prospects as far as the senior notes holders are concerned, because the bare bone liquidation may be very low by the time they are liquidated to meet the obligation of the senior notes holder themselves. Moving to the rating agencies, why rating agencies become important? The first and foremost thing is that they assess the issue independently without any motive or malice thereof. Second is that, when we talk about issues of, let's say, we are talking about an issue based out of US, and we need to compare that with an issue that has been floated very recently in the Philippines. Now, I, as an investor, how much of a confidence can I place with the issue that has just been floated in the Philippines vis-a-vis that of the US market, which is a developed economy? So I need somebody to validate, authenticate, and certify that. And that is where agencies like Moody, Standard & Poor, Fitch, these three global agencies come into rescue. They have certain standards, and those standards are implemented uniformly. Mind you, I'm not saying equally, but I'm saying uniformly, based on several other barometers, basis which they would issue a country rating, basis which they would also issue the particular issues rating. So when I know for sure that a double A rated bond in US vis-a-vis a double A rated bond in Philippines, though they may not be very same, they may not be very same in letter and spirit, but they would be very near to altogether because it has been certified by a renowned and reputable agency. So it helps us making the comparison between issuers. And here we talked about two sovereigns. It also, in a similar manner, it also helps in comparing issues of different issues of the same issuer as well. Regulatory compliance may become one of the very important reasons why the rating agency might be brought into play. For instance, institutional investors, file like that of the pension funds, hedge funds, or retirement funds, they are allowed to invest only in high graded, practically very select securities. So until and this is a regulatory compliance. So until and unless there is an external agency to certify and authenticate the validity and the sanctity of such investment venues, the potential investors in the form of a pension fund or the retirement fund may be left out of the whole investment game. So from that perspective as well, the regulatory compliance becomes of paramount importance. And also the explosion of the bond market itself the world over. So these are the different aspects why a rating agency is important, and their growing and their significance is growing, despite a huge catastrophe of that of 2008 subprime crisis. Now, a little bit of a gradation here. So normally the grades are roughly subdivided into two halves: investment grade and the non-investment grade. The investment grade further is subdivided into high grade to upper medium grade, lower medium grade. And the non-investment grades mostly are categorized into three halves. They're speculative, highly speculative, and default category, basically. In addition, these rating agencies issue two types of rating. One is a short-term rating, and second is a long-term rating. The idea behind that is that because not all bondholders' investment horizon will or must coincide with that of the whole tenor of the bond, so I might not be interested in the whole hog of this AA2 rating because I don't intend to hold this bond for the tenor of the securities. My investment horizon might just be only 3 years. So for me, or let me say just only a year. So for me, this P1 makes more of a significance. It comforts me more than this long-term AA2. So this is how the nomenclatures are. Moody's normally have their investment grade culminating at Baa3, and that of S&P is triple B minus, which is also triple B minus. Okay, so from there now we move to something called as the corporate family rating and the corporate credit rating. Basically, it's not much of a complicated thing. So just know this, that the first unsecured note in the hierarchical structure of the debt. Remember, we talked about that columnar structures of debt. So in that we had the first lien or the first secured, the second lien or the second secured, and then there's this first unsecured that comes into picture. So the corporate family rating is nothing but this first unsecured rating itself. Okay, so just remember this, and that is it. There is nothing more to remember in this whole thing. Now, another aspect is that as an investor, should I be only worried about the issue zone rating or the corporate family rating as well? Yes, I need to know the corporate family rating as well as the issue rating as well. And at the same time, typically, I would also want to know the variance between the two. It would give me the necessary yardstick. Okay, so as I was discussing in the preceding slides about the cross default provisioning and why it becomes important. As an investor, I need to keep an eye on those issues as well where I'm not invested, if it pertains to a particular issuer. Just because to know that if there is a propensity or likelihood to default elsewhere. And if it does happen, so it's like a house on fire kind of a thing. So once it engulfs the whole house, there is very little chance that you would escape unscathed unless you have taken the necessary precaution. Much beforehand, you spotted the fire. So that's cross default provisioning for you. I'm not going to spend much time on that anymore because I believe that what I've explained should be abundantly clear. Next, move to the process of notching. So notching is basically the rating adjustment. So typically what happens is that the rating process is capturing a static picture of otherwise a dynamic market. Now, from time to time, the prospects of the issuer may worsen or it may improve. Now, how does it affect my holding as a bond investor? If, as I said before, if I'm a long-term investor and I have issued and I have invested into the highest category of the bond in the market, which is supposed or which is deemed to be the safest in the whole structure, then per se, I'm really not much worried about unless and until I have some telltale issues, which I need to keep an eye on. But other than that, I'm really not much worried about the momentary blips in the issuers or the corporates status quo. So either on the plus side or on the minus side, I need not really adjust the rating of such issues because such issues are completely immune to the extent possible against much of the vagaries in the market or much of the volatilities in and around surrounding the corporate and its management itself or these prospects itself. So here the adjustments towards that will be minimal. So these adjustments pertaining to the concurrent or the momentary blip in the market or the any substantial deterioration in the credit quality of the market or any improvement in the credit quality of the issuer itself is called the notching process. So the notching process is nothing but the response by the issuer, by the rating agency, that captures the sentiment, that captures the ethos, and that captures actually the status quo of the issuer itself with regards to the changes. That's what notching is. So it's an adjustment process. All that you need to know that it's just an adjustment process that is being impacted or that is being worked upon by the rating agencies to the changing circumstances of the issuer or how it is being impacted because of the changing circumstances in the market. Either one of them, either inherent, either unsystematic or systematic. Now, as I said before, that in the columnar structure, the senior notes holder are relatively unaffected because of these momentary blips. However, so their adjustments are little. However, same is not the case as we move down the hierarchy. So the lower ranked issues are more susceptible and they're more vulnerable to the changes. In fact, as we know that they are pretty volatile in nature to the changing circumstances of the issuer in the market. So in such a case, the adjustments will also have to reflect those changes. And the adjustment, typically the convention is that if the company's prospects worsens, then the lower ranks issues are notched 2 grades downwards, while the upper rank may be notched only 1 grade downward. Subsequently, if the company's prospects improves, the lower rank issue will only be upgraded 1 notch, while the upper ranked or the senior notes holder will also be adjusted 1 notch, and they would retain their original ranking. But the lower notch issue in this case, or lower ranked issue in this case, will still be lagging behind its original status quo. So this is the whole sentiments of what notching is all about. So that's why I'd say that notching is asymmetric in nature. For a corporate family rating deterioration, the notching may be 2 grades for a non-investment grade bond versus 1 or a 0 grade for an investment grade bond. However, for subsequent improvement, the non-investment grade may not be awarded 2 upgrades while the investment grade bond may appreciate. Of course, notching is also dependent upon how the adjustment will be made, is also dependent upon the structural hierarchy. No surprise in that. Default risk, loss given default recovery rate, and the cross default provisioning. But natural, if you have followed through the discussion so far, the lower ranked issues are more susceptible to all of these risks. as compared to the higher ranked issues, which are not that much susceptible, or they're, let's say, they're much more immune to these risks. Okay. So the next important things is that how much of a reliance can we place on the credit rating agency's opinion? So the first thing that I discussed is that it's like a moving picture to which a credit rating agency basically assigns a static status. So this static status is just a snapshot picture, picture of an otherwise a moving a moving picture itself. Okay. Second is that ratings obviously they do not stay constant. They might do migrate over time. So typically, it has been seen that if you follow through the CFI example that they've quoted, the migration from a AAA security to a lower grade security has been very minimal over a considerable period of time, which might be even 25 years. But a double A security has, over the period of 25 years, has been found to be downgraded to, let's say, around close to 7% of them. Over a period of 25 years, they were found to be downgraded to 7% of them. Only 1% of these AA rated securities have gone to the extent of AAA security. Similarly, if you go to the triple B security, you will find the triple B security over a period of 25 years, almost 27% of them have been downgraded there. So that's called rating migration. So rating migration happens. So what has been rated today, what is seemingly good today, may be personally absolutely all right, given the relevant facts and the relevant status. But hey, those status, those scores, they're not carved in piece of stone, and they're not going to stay forever the same. They will change over time. Ratings necessarily lag market outlook. How many times do I explain this? But of course, because ratings are done once in a while, or if there be a catastrophe which has already happened, because of which the rating will have to change. So necessarily they will lag the market outlook. Something needs to happen in order for the rating agencies to change the outlook of the issue itself, because changing of outlook of an issue does not happen overnight every day. But obvious rating agencies are also not infallible, because if it were not so, we would not have seen the 2008 mega crisis itself. So at best, and I reiterated the quotes given by the who's who of the rating agencies, that our ratings are our considered opinion. So basically what they're saying is that buyer beware, investors be aware, which is also called as caveat emptor. So it's not sufficient only to place 100% reliance on the rating agency, but one should do one's own due diligence. But having said that, just as we have learned before, that our high yield securities, lower ranked securities, that's where the due diligence becomes all the more prominent. That's where, in fact, the majority of the bulk of the due diligence lies. For example, if I were to really analyze a AAA security, should I really be wasting my time? Yes, it's absolutely a waste of time doing any analysis of AAA security. But let's say a AA security, I might spend some time. Definitely not much of a time as compared to that of a triple B security, because this is where the borderline investment grade and the non-investment grade security comes into picture. So if I'm not vigilant here, chances are that they would have slipped the hamster wheel, and that's where basically, if my due diligence is not on time, I might have to bear the losses. Okay, now we move to the four C's of this is also called the holy grail of the fixed income analysis: capacity, collateral, character, and covenants. So what is capacity is basically the ability to pay, and that's based upon a couple of important, in fact, three important things. That's the macro factors, company fundamentals, and issuers' liquidity positions. We're going to study each one of them individually. Collaterals are basically the hard assets backing the particular issue. And as I've said before, that senior notes holder are exclusively, more often than not, are protected by specific assets in addition to the general lien that they enjoy over the overall assets of a company. The junior notes holder are not that lucky, and they are not tied with any particular assets, but they only enjoy the lien they only enjoy the general lien, and that too hierarchically subordinated to their senior structures, to their senior note holders. And here it beggars a mention about the kind of assets itself. Typically, the hard assets will be valued more. The soft assets per se are really not that reliable a thing as far as collaterals is concerned. So, for example, goodwill or a human capital, really, human capital cannot be capitalized. Goodwill, on the other hand, is not amortized or depreciated. They're only tested for impairment annually. So they really don't form part of a good collateral. A good collateral would mean solid state fixed assets. A good collateral would also mean a copyright, an exclusive marketing orders which lend an over order book lend spread over 10 years for the next 10 years, turnkey projects. So these are hard assets. These are good collaterals. But at the same time, as mentioned before, the periodic evaluation of the good collaterals are also important. Covenants are basically the stipulated condition in the bond prospectus. We have discussed this amply in our preceding chapters, in our preceding clients. There are a couple of types of covenants. One is called the positive covenants, and second is called the restrictive or the negative covenants. So positive covenants are the ones which you must do, and then the negative covenants are the ones which you should not do, or at least stay away, steer clear, and refrain from doing so. So the positive covenants basically, now here I must make an important distinction, which I believe that I've already mentioned of in my preceding chapter. Complying to the regulation, complying to tax authorities, that's not covenant. Okay, covenants are indelibly mentioned in the bond prospectus. So positive covenants would be like maintenance of a particular debt service coverage ratio. That's called positive covenants. A positive covenants would also mean that the bond holders are being paid on time, and they're also not only paid on time as far as their coupons are concerned, but also their amortized principal. There should not be any delay. And if there be any delay, then there would be subsequent penalty imposed upon the bond issuer. So that's positive covenants. So these are the things that the bond issuer must adhere to, must do. The restricted covenants, on the other hand, could be, the bond issuer will not indulge into any sort of risky project other than the ones which has already been mentioned. They would not shower themselves on the equity shareholders excessive dividends or payouts. Now, they would not indulge into, extreme amount of compensation for the senior management. Basically, they should not undertake anything or should not do anything that may impair the interests of the notes holder, the bondholders. So those are the restrictive covenants. But having said this, the restrictive covenants should not be too restrictive also, so as to take away the flexibility that the issuer enjoys. Because if it is so, then it may indirectly hurt the prospects of the bondholder itself. Because in such a situation, the recoup of the principal may take more than the usual time. Character. Now, the character, of course, defines what the corporate is all about. It starts with how the management views itself, and what the management, basically it's what you need to do. Then it's a very simple in layman terms as well. If you want to lend somebody money, what are you going to look back upon? So the first thing that you're going to look back upon, what you're going to assess is, what is the propensity, what is the likelihood that the borrower may default? What is it, the market reputation of the borrower? How the borrower has treated its past lender? Have they indulged in any sort of cheating or fraudulent activity, or any sort of malfeasance have taken place? Any sort of mistreatment to the bondholders have had taken place, which may be other than default, for example, delinquency, persistent delinquency. So these track records are very, very important, especially borrowers who do not have sufficient operating history, or borrowers who really do not have much of a history. They are very new as far as bond market itself is concerned. It becomes that much more important on part of the bond investors to do their necessary due diligence in order to assess what could be the probable loopholes. So basically, we need to know who are the people behind the company, what is the character of the management overall. Now, as I said before, the capacity is tied up with three things: the macro factors, the company fundamentals, and the issuer's liquidity position. So these are basically the hierarchically, in a pecking order, they have been put here. As I said before, why issuers liquidity become important? So as I said before, that should there could be a need, there could be, one of many needs, which I'm going to discuss further in my subsequent slides. wherein the issuer or a portion of this issue might have to be retired abruptly. So, or one particular quarter or one particular 6 months of a company may not have been that good. They may not have generated enough cash to meet its coupon obligation. But in such a situation, if there are sufficient cash on the company's balance sheet, that boosts the necessary confidence. So the proportion of cash in its whole assets base of a company could be a great thing. For instance, if I have to tell you, and I'm drawing a parallel, it may or may not be correct. General Motors, Fords, these big automakers, they have piles of cash on their balance sheet. They're very poor as far as working capital management is concerned. But the very reason that they have subsequent cash buffer, that kind of boosts the confidence of the bondholders. uh, Once GM or Ford Motor Company, they issue new debt securities in the market. Second is the untapped committed lines of credit. The deeper, the better. But however, one needs to understand that this credit line uh, also suffers from the counterparty risk, because indirectly you are now believing in the accessing capacity. You're actually relying on the accessing power of the issuer in order to open the lines of credit should there be a need of that. At the same time, we need to understand that the party, to which it is falling back, even that party could face bad times. For example, there could be a run on a bank on which the committed lines of credit was actually awarded in the very first place. So what does that happen? Do we go to the extent of doing our due diligence? Possibly we do not actually do so, but a cursory understanding of the where the untapped committed lines of credit lies is an important thing. Working capital management, of course, all that we look for is that this should not vary too much from year to year. It's non-volatile. Working capital management would give you that much amount of liberty to do the cash flow position of a company. Now, you might want to understand that why a debt holder wants to do a cash flow position of a company. As said before, that you could be a senior notes holder, you could be a junior notes holder as well. More often than not, the junior notes holder, the junk notes, have characteristics very similar to that of equity stockholders. So, to that extent, it becomes pertinent to do one's due own cash flow projection given the constraints of the company, given the assets of the company, all the information that you have in your disposal about the company. Working capital happens to be one of them. Balance between the planned capital expenditures, sources, and net debt repayment capacity. Now, this is again a very, very important thing. Asset sale is seen as the worst kind of avenue in order to meet the issuers, in order to meet the obligation of the issuer in terms of either coupon or the principal itself. Asset sale, basically what it talks about is liquidation, even if it is only one particular asset. Nonetheless, we need to understand that the company's forthcoming prospects or forthcoming schedule for the next 5 years or 7 years time, as far as its fixed assets are concerned, how are they going to meet up the need for funding those assets? And more importantly, how are they going to pay them back? Okay, so from there we go down to discussing the Porter's Five Force model. So Porter's Five Force model essentially talks about the industry structure, the industry fundamentals. So I'm going to touch base upon them because this is what you're going to uh, be concerned about as far as your level 1 is concerned. So threat of a new entrance, just know this, that in a particular industry, uh, if there be too many players, so the competitive edge is lost, and the moment the competitive edge is lost, the ability to generate free cash flow reduces that much, and it all the more is exacerbated if there is a threat of new entrant. Supplier's bargaining power. If the issuer supplier has more bargaining power in a monopolistic industry itself, so such an industry will obviously flex more muscle to its customer and obviously will hurt the prospects of the bondholders. Similarly, if the customer's bargaining power is less, such issuer benefits from the monopoly. So you see the difference, how it has actually turned the table here. Threat of substitute, typewriters, Kodak film cameras, Up until late 90s, early 2000s, they were still a very, very big company. However, as the time passed, as new technology came into being, the typewriters were phased out in favor of fast laptops, computers. Digital camera substituted the market of the films and the traditional camera. So also we need to understand that is the issue coming from an industry where threat of substitute is very imminent. Happens all the time if you can if the issue is from a technological industry itself. Competitive intensity. For example, we mentioned about the cyclical industries, that of steel. Now, from one steel producer to another, really speaking, they are basic commodities and very little to differentiate. So, in such a situation, the only way one steel producer, may differentiate with other is how efficiently it manages its operation, how efficiently it allocates its capital. So, more the competitive intensity, more these tasks will become difficult. More these tasks will become difficult, lesser will be the propensity that the cash flows of the bondholders will be met on time, and it will come under pressure. So you just need to understand that these are the five forces that define any industry, and a positive impact will help your cause, whereas the negative impact will take away the flexibility and the power of the issuer in order to meet its debt obligation. Cyclic industry fundamentals, we talked about the cyclical versus non-cyclical type of industry. Which kind of industry you are prospecting in, that would obviously govern the propensity that you're going to receive your cash flows on time, promise cash flows on time. Secondly, the growth prospect result. Again, I would like to make mention of the obsolete industries of today. For example, typewriter or that of film cameras. So until and unless you are actually in a company, in an industry which has a good growth prospects, the subsequent debt issuing may become that much more challenging. Again, at the same with the same concept, that one might like to think that growth primarily affects that of the equity shareholders, because as far as the fixed income debt holders are concerned, they are more concerned with their face value and the principal that they have been promised. Well, as lucid and as uh, believable it may sound, if the growth prospect itself is limited in an industry, how are they going to meet their debt obligation? Their debt obligation is also going to come under pressure. So even though the fixed income notes holder have limited upside potential to their instrument investments instrument, still the growth prospect of the industry in which they're investing also need to be looked into. Last but not the least, the published industry strategies. Now here I want to make a quick distinction between that of a developed market vis-a-vis an emerging market. Typically, you could place obviously much more reliance on the industry statistic being published by the developed economy vis-a-vis that of the emerging economy. Companies fundamentals, I'm not going to repeat all of the things that we have talked about. Basically, just you need to know that what is the intent of the management, what has been the past record of the management, has the management been really friends of the bondholders, or is the management new, does the management really walk the path, walk the talk, what has been their operating history, how have they treated the past bondholders, has there any litigation that's been going on, or any of the bondholder class have been impaired, any of the fines or sanctions are there that are being imposed on the issuer in the recent past. So all of these things will need to be looked into. Even if they're not to be looked into at a very depth, at least a cursory review or a broad overview should be sufficient. Last but not the least is the profitability in the cash flow. Now, here I need to make, I just need to make mention of that. The CFI text, there is an example 6 that has been given. I want all of you to practice that particular example, and that example will capture the whole theme of the ratio analysis itself. Please understand, they are more concerned with your FRA part, accounting part, but here they have been this particular problem has been gleaned out to clarify the concepts of the ratio analysis from the fixed income perspective. So I've just made a summary slide, a summary table of them. I'm not going to reproduce the same problem because it really does not quite serve the purpose as far as fixed income is concerned. But just know this, that these are the things that you need to keep into mind. Uh, Basically, there are three things in ratio analysis: profitability and cash flow analysis, leverage analysis, and the coverage analysis. Now, I first start with the coverage analysis. Just need to understand that the interest coverage ratio, either measured by the EBIT by interest cost, net interest cost, or EBITDA by net interest cost, higher they are, better it is. Leverage ratios, lower they are, better it is. For example, debt to capital. So if you have existing debt only 25% in the capital, that means that you have room to issue more debt. However, you already have 75% of the debt. Your capital comprises of 75% of debt. The room to issue additional debt becomes that much more smaller, obviously. Similarly, debt to EBITDA ratio, and then a couple of more ratios that we need to understand as part of leverage. One is funds flow from operation, and the second is free cash flow post dividend. Okay, so higher they are, better it is. On part of the profitability cash flow, again, they are as easy as they come by. Uh, Net operating income, the greater the operating income in absolute value, better it is. Greater the funds flow from operation, better it is. Greater the cash flow from operations, better it is. As you can see that the only difference between funds flow from operation and cash flow from operation is the change in working capital. More the free cash flow before dividend and after dividend, better it is. So I would strongly suggest, please work out the problem there. And if you have any queries towards that, please come back to me. You can always ping me in my email ID. I will be more than glad to answer and clarify. Okay. So with this, we come to the next portion of our chapter, that is the credit spread, yield. Sorry. Yeah. So yield and volatility risk, spread risk. So these are the things. So just know this, all of this we have already discovered, we have already discussed. And here I'm going to fall back upon our old concept of um, Clomby. I hope you remember this acronym called Clomby. If you do not, then I'll make a mention of this. C stands for credit spread, L stands for liquidity spread, O stands for the option spread, M maturity spread, business cycles spread. I'm sorry, this is again one more. Maturity spread, then another M stands for the modeling spread, B stands for the business cycle spread, and I stands for the inflation spread. Now over the reference curve, this is the reference curve or the benchmark curve. All of these spreads are stackable in nature, which ultimately form part of the yield curve. So your yield curve basically comprises of the reference curve plus this Clomby spread. So where do you believe this Clomby spread will be more pronounced? Yes, you guessed it right. It will be more pronounced in the high yield and the lower high yield bonds and the lower ranked securities. So spread risk is typically more pronounced as we move along the credit grades downwards. In addition, there are some concurrent factors as well. So these are the 5 concurrent factors that we need to take into consideration. Credit cycle, when everything is all right, the credit risk will narrow across the rank and file. So in good times, when the economy is doing good, so we are in somewhere here, it is advisable that you invest into high yield securities. Why? Because since everything is good, the credit cycle is good, it is that much more unlikely that your high yield bond will suffer any sort of credit loss or they will suffer any sort of default. So it makes sense to assume the risk and invest in high yield securities. Exactly opposite is the true when the credit cycle itself economy is in bad shape. In such a situation, you should avoid the high yield securities, and if you have to at all invest, do invest in the low yield high grade securities. Okay, so that is what is being meant by the credit cycle, that when your credit spread, the widening or the narrowing of this credit spread depends upon which part of the credit cycle we are in or we are talking about. Overall economic conditions being good, yes, this takes care of the same thing. Financial market performance, obviously, if we are talking about the developed market, which is a developed capital market as well, so everything will be much better than that of the emerging markets or the underdeveloped markets. Underdeveloped markets are known as inefficient markets. They're weak in nature financially, economically, and will definitely require wider spread. Credit leverage and margin trading, of course, uh, credit spread has increased considerably after the 2008 crisis, because in 2008 a lot of broker dealers, they have actually gone bust. They had to shut down their shop because they were providing their clients a high degree of leverage, high degree of margin, even to the tune of 1 is to, at the peak of it, at the peak of the bubble, subprime bubble, the leverage ratio was as high as 1 is to 33. Now imagine when the system collapsed, what happened to the broker dealers. So those broker dealers have become much more cautious now. They burned their fingers. So after 2008, the brokers' propensity to extend those kind of margins, those kind of leverage are no more there. They have considerably tightened, and they've subsequently and considerably tightened their margins and the required liquidity that they were providing their clients. And last but not the least, how the credit spread will be determined is also a function of the demand supply situation. So what is a credit spread? Credit spread, to begin with, is basically these spreads which sit over and above the reference curve, as has been explained. But obvious that the high yield, low graded securities will have more credit spread, all other things remaining constant, as compared to the developed, as compared to the low yield, high graded securities. Now, to elucidate that, I have also depicted a picture taken directly from the CFI text. As you may see that the average return difference between the AAA security and that of a CAA security is almost double. While the CAA security gives you very high yield, the volatility is also 4 times that of the AAA security, which is measured at 3.43% vis-a-vis this 11%. Okay, so high yield corporates, sovereigns, and non-sovereign government bonds. This is the last piece of our learning. High yield corporates, we have already discussed. Most of the high yield issues lack alternate source of funding. For example, commercial paper. They face liquidity issues because they cannot, they will have limited access to the untapped lines of credit, or they will have limited cash in their bank. It is but obvious. Hence, rolling over such debt becomes a challenge for them. And more importantly, the high yield issue at times may not have a publicly floated equity as well, which actually adds to the information asymmetry all the more. And once this information asymmetry becomes public, widespread, it in turn adds to the liquidity problem of the publicly floated debt which is already there in the market. So we need to understand that the high yield corporates are not only susceptible and sensitive and vulnerable to the macroeconomic factors, but also pretty much are susceptible, and they are pretty much sensitive to their internal unsystematic factors as well. The low yield, high graded bonds, or low yield, high graded corporate issues, on the other hand, are more susceptible to the macro factors rather than their own inherent unsystematic factors. Now, why a high yield security are considered junk? I have already explained, because of the industry structure itself, which kind of industry they are in. Are they in a declining industry, or they are in highly cyclical industry? Are they in industry where differential advantage does not exist at all? Are they in an industry which is not favored by the government or the policymakers anymore? Or there could be company specific factors as well. For example, the high yield securities are the one where it is already highly leveraged. They do not have enough operating history. That's why they have to offer higher yield in order to entice the customer. So all of this we have already discussed. We have discussed this hierarchy as well, that in order to meet the liquidity demand, this is what is being preferred. So the if you're analyzing a high yield issue, please also understand the proportion of these assets hierarchically. This is a waterfall structure. So more the cash is there on the balance sheet, more cash is there on the balance sheet, that boost your confidence as far as high yield issues are concerned. The least favorable or the least desirable is when the issuer has ultimately got to sell its asset in order to meet its demand. So it's like killing the golden goose. Because of all of these, the high yield issues do not actually undergo the same evaluation process as that of the low yield high graded bonds. They in fact embed both the characteristics of equity analysis as well as the fixed income analysis. Quite rightly, quite aptly, they are termed the hybrid instruments. Okay, so here we are going to take a quick look on the covenant analysis. Should there be, what kind of covenant analysis are good or bad, or what should be actually be put? So typically, if you are actually investing in a high yield security, or you are investing in let's say emerging market bonds, you should not only read the bond prospectus thoroughly, but you should also insist, if you are a prime issuer or you are an underwriter, must insist on few of the restrictive covenants. So one of the restrictive covenants is change of control put. What it means is that if the particular issuer is a candidate for a hostile takeover in the market, and if should that happen, so in such a situation, the issuer, the bondholder must retain the right to retire their outstanding principal at the moment of acquisition itself at a premium, so that it becomes that much more difficult for the new acquirer to assume the debt in the market. Restrictive payouts, we have already discussed that, just because there is excess money lying on the company's balance sheet, the management should not actually see the management, the equity holder or the board actually works for the equity shareholders. We do understand equity shareholders, as rightly mentioned, are the ones who share in the upside potential, but of course they buy in the downside risk as well. On the other hand, the bondholders are seen as a cost center because that's more of an obligation. You don't share in the upside potential unless it's a convertible instrument. So because the choice, the prerogative lies in the hands of the management, the bond prospectus must actually put some sort of capping in terms of the bonuses or the buybacks of shares or excessive dividends or excessive compensation that can be doled out to the management or the equity shareholders of the company. Additional indebtedness, of course, this plays a major role. Now here I must make a special mention of that. For example, suppose in a columnar structure of debt, already let's say an X amount has already been issued in the market as debt security. Of this X percent, let's say del X percent pertains to high yield unsecured notes. Now, if tomorrow the issuer wants to introduce a small secured component of debt in this whole debt structure already, please be known that this small secured structure will eventually sit over and above hierarchically this del X, so that it does not happen. Because if it happens, if it does happen, then obviously it is going to hurt the interest of this high yield issuer or the unsecured notes holder. So a mention of the limitations on liens and check on additional indebtedness becomes that much more important. You see how a covenant protects the interest of the most vulnerable notes holder actually depicts the strength of the bond prospectus himself. So even if I'm a secured note holder, I must make an analysis, and it's already mentioned in the bond prospectus, that how the issuer intends to uphold the interest and protect the interest of the junior most notes holder. Because the more protected the junior notes holders are, the more protected the senior notes holder automatically becomes. Upstream facilities and nature of from the subsidiary. Now, it may also so happen that an issuer has a subsidiary, and the subsidiary in turn is a profitable subsidiary, of course, has also its own debt. Now, but obvious that the subsidiary will meet its debt obligation first. If it's a profitable subsidiary, it will meet its debt obligation first before it could actually upstream the cash flow back to its parent. Now, if the issuer has a new debt on its balance sheet, if the issuer has a new debt on its balance sheet, does this new debt get serviced because of this subsidiary's upstream cash flow? If it is so, what are the conditions stipulated there? Does the issuer accord the debt in its subsidiary, or in other words, does the subsidiary accord the new debt in its balance sheet pari passu to its existing debt? So this kind of seniority ranking, this kind of hierarchical ranking, even in a parent subsidiary relationship, and understanding of that, it also is important as far as bond prospectus are concerned. So these are part of covenant analysis that one needs to do as part of one's due diligence. Now, this coming to the last portion of our whole exercise, that framework for assessment of the sovereign debts vis-a-vis the sovereign debts are again categorized into two. One is the sovereign government and the sovereign non-government, but obviously the primary difference between the two is that the sovereign governments are backed by the full faith of the government itself, uh, and as far as its domestic currency is concerned, it is very unlikely that it will ever default. And the emerging markets, if any, even if they issue a sovereign debt, they more often than not will issue the sovereign debt based on hard currencies like that of the US dollar or euro. On the other hand, the non-sovereign government debts could be that of the corporations or the municipalities. Now, the typical difference between the two is that the municipality bonds are of two sorts. One is the general obligation bond, and second is the revenue bond. The revenue bonds are closely tied with the specific project for which the municipality has issued the debt in the first place. And it is being governed by three important factors. First is the income per capita in its jurisdiction. Second is the revenue itself. And third is the population growth itself. Now, you might ask why population growth is important. Because population growth translates into the labor force input. A labor force input would translate into labor contribution to the project itself. The more labor contribution or the more labor productivity comes into picture, greater the propensity that the municipality will be able to meet its debt obligation. On the other hand, the local government, non-sovereign local government, is impaired as far as utilization of the monetary policies are concerned. The sovereign, on the other hand, makes use of the monetary policy, basically its fiscal policy and monetary policies, and the role of its central bank in order to, it fine-tunes all of them in order to meet its sovereign debt, especially if it is issued in hard currencies. Now, in this also, there are a few more things that we need to understand, and those are the flexibility and the performance profile, external assessment, fiscal assessment, and monetary assessment. So at sovereign level, what, even if it is issued in hard currency, what is the value of its own currency? Is the value likely to depreciate, or it has been issued at a, is the currency tied in as a pegged value? Because if it tied as a pegged value, the sovereign may face very restrictive covenants which may impair its flexibility, which subsequently may affect its bond repayment capacity. External debt, higher the external debt, but obvious, higher the external risk as compared to the GDP, but obvious that it will become that much more difficult to service that debt. Lower the liquidity, but obvious it will find it that much more harder to service their debt. Fiscal assessment, on the other hand, takes into assessment of the net debt burden, the trend economy, the long-term fiscal trends, and access to foreign funding. Foreign funding would mean access to bodies like the IMF, World Bank, supranational organization, Asian Development Bank, African Development Bank, and etc. Monetary assessment, of course, conducive and progressive monetary policy on ground of implementation, degree of flexibility in keeping exchange rates free floating, track record of previous policy implementation, well developed capital markets and banking system. Because we need to understand that in any sovereign, the central bank is the last resort of lending. And if the more infrequent the sovereign or its member bank has to fall back upon the central bank in order to borrow or meet its debt obligation, the better the health of the nation is in general. Secondly, even if some of the monetary policies and fiscal policies are to be implemented, they are being implemented through a tool called as bond buying program or bond selling program. Many of you who are currently witnessing, or you would have heard the murmur called the tapering that the US Fed is embarking upon, is based on the bond buying and the selling program, or the variance of the two. Now, more often than not, the central bank of a sovereign does this through something called as the open market operations, rather than stipulating some administrative tools. So long as they do it without changing the status quo of the market or without disturbing the status quo of the market, that is considered a good practice. So I would want all of you to pause this video and read out this narrative which I've written. This will give you a better understanding of the sovereign debt. We already discussed about the revenue bonds, contingent on the purpose of project specific, since project specific hence carries high degree of risk, but of course certain maintenance covenants in the form of DSCR are to be incorporated, and general obligation are backed with the full faith of the issuer, serviced by the local taxing authority. But obviously a municipality or a state or a will have its own local taxing authority, which is other than that of the national government. But as mentioned, that the municipalities will not have the power to exploit the policy effects of the policy implementation tools like that of the monetary or the fiscal things, as the sovereigns otherwise could have. So that brings us to the end of the reading 47. I believe that you have extensively enjoyed this particular part of fixed income. And as before, if you have any queries, please reach out to me at my email ID. I will be more than glad to take your questions. Thank you very much.